Greetings, everybody. Welcome back to Strongman Personal Finance. We have a sponsored video today. That's right. Somebody wanted me to make a video on the Peter Lynch 6 categories of stocks. Apparently, there's 6 types of stocks. Now, when you're a stock picker, right, you gotta understand what you're doing. Okay, a lot of you think you understand what you're doing, but you're just buying stonks that went up a lot, and if they go up more, you think you're a genius. But you have to understand at least the basics of what you're buying, okay? And Everything Money has this flaw. Oh, by the way, Everything Money, they just do their little DCF on literally every type of stock, regardless of what industry the stock's in or whether it's a cyclical stock, et cetera, et cetera. But we're going to go ahead and explore the Peter Lynch 6 categories of stocks, and we're going to learn how to crush the S&P 500. Well, who is Peter Lynch? Who is this man, okay? Well, this famous master stock picker said this brilliant quote: "If you only invest in an index, you'll never beat it." By golly, I've never heard a more intelligent statement in my entire life. But in all seriousness, and I know some of you little elementary school teachers are probably cringing right now. Wikipedia, oh my God, no! Peter Lynch is an American investor, mutual fund manager, and philanthropist. As a manager of the Magellan Fund at Fidelity Investments, I got some stonks in there, between 1977 and 1990, so over 13 years, he averaged a 29.2% annual return, more than double the S&P 500, making it the best performing mutual fund in the world, okay? And of course, all the clowns, you can see why retail is clowns. During his 13-year tenure, assets under management increased from $18 million to $14 billion. So this guy, he knows what he's doing, right? Does that mean retail, whoever bought into his fund, got 29.2%? I highly doubt it for reasons we won't discuss right now. But he's very successful, okay? Obviously, he knows something. Now, what he does is he likes to divide stocks into 6 different categories. We're going to talk about each one and get Peter Lynch's thoughts. So there's 6 categories of stonks, okay? There's slow growers, there's stalwarts, fast growers. When I see the word grower, I always think of something. Cyclicals, like Smith & Wesson, Everything Money. Turnarounds, and asset plays. So let's go ahead and dive into each one. Slow growers are large and mature companies. They're expected to grow slightly faster than the gross domestic product, the national income, GDP. They grow at a rate of between 2 and 4%. What if your GDP is 6%, bro? Companies with slow growth can expect low increases in price. Examples include Walmart, Coca-Cola, and Colgate-Palmolive. Okay, I think most people understand this. It's like this is very mature companies that usually pay dividends, which is free income from the sky. That's why I always love dividend stocks. And they're very mature companies. I mean, like, if you think about Walmart, is Walmart going to 20x? No, Walmart's not going to 20x, okay? Maybe if there's hyperinflation, Walmart with 20x. But we all know, like, deep down inside, Walmart's not going to 20x. It's already got most of its stock price appreciation. Now, the stock can still go up, and you can still get a return out of it. But if you're trying to crush the index, okay, you'll probably you have a good chance of potentially matching the index with one of these stocks, but you're also taking more risk for buying an individual stock. So if you're like young and you want to, 10x my Henhex, maybe you don't want to buy Walmart, Coca-Cola, and Colgate-Palmolive. Maybe you want to look for another stock. Okay, what are some examples? Increased earnings over the past 10 years. You want earnings growth. I mean, that's really the fundamental driver of stock returns. An attractive dividend yield. No comment there. It has never reduced or suspended its dividend. Now, that's a good point. Now, there's this thing called the dividend irrelevance theory, which I'm going to really dive into and probably make a video about. But the reason you should be concerned about a stock cutting its dividend, even if it's for a good reason. Let's say a company's packing on debt and they want to pay off some of their debt. Okay, cut the stupid dividend. Pay off the debt. I'm fine with that, especially if the debt's high interest. But there's other clowns out there that solely buy the stock because of the dividend. That's it, because they think they're getting free money from the sky. And if a company suspends their dividend, the stock could go down, okay? And that would really hurt you. So be careful with that. And it raises its dividend in good times and bad. I don't know why that's a good thing. I mean, if times are really that bad, maybe you shouldn't raise your dividend or temporarily suspend it. You should sell a slow grower if fundamentals have deteriorated. I would say that's for every stunk. The company has lost market share for 2 consecutive years. Okay. The company has reduced spending on R&D, and the company's making many acquisitions that are hurting its balance sheet. Okay. I think we all understand what a slow grower is. If you're young and you want a hen hex, you probably don't want to buy it. Next, we have the Stalwarts. Warts. Okay. Make sure I'm sharing my screen. Okay, we're sharing the screen here. Stalwarts are multi-billion-dollar companies that grow slightly faster than the slow growers. Stalwarts should grow their earnings at 10 to 12%. And eventually, a stalwart will probably become a slow grower. Every company eventually reaches its maximum potential, wherever it's at. Examples include FedEx, Oracle, and American Express. They are low risk and moderate reward. If everything goes right, you can make 30 to 50%. Well, if you buy anything at the right price, you can make 30 to 50%. That isn't like out of this world. If something goes wrong, you might lose 20%. I also don't agree with that. I mean, a stock that rapidly deteriorates, you could lose a lot more than 20%. Things you should look at a Stalwart are it's selling at a low range of its price to earnings. I mean, PE, there's a lot of ways that PE can be distorted, okay? You got to be careful with PE. It's a whole other video. That the stock hasn't risen a lot on its current run. See, that's a key thing for any stock, okay? All you YouTubers, you just buy stonks that go up a lot. You think you're freaking geniuses. And they go up more. And oh my God, I'm so smart. Potential growth catalysts, and it can maintain profits during recessions, okay? Was FedEx unprofitable during the recession? Hold on a second. If FedEx is a good stalwart. Okay. Let's see. Annual growth rates. 11, 21, 6, 8, 19, 6, 4. Yeah, it's definitely more of a stalwart. Okay. And they actually had pretty explosive revenue growth after the pandemic lockdowns. Did they lose money during the pandemic though? Have they always been profitable? Let's see. Yeah, they stayed profitable. Okay. Good for them. I guess it qualifies. You should sell a Stalwart if the PE strays too far from its normal range. Let's see, what is a normal range of FedEx? Let's see. You see how this is like an art, not a science? Okay, so let's do trailing. Let's see what that is. PE. Well, before the pandemic, it was definitely 15 to 20. Okay. And now it's 16. So it's not like outside the range. Okay. I mean, it's a little expensive compared to, I guess, a couple previous quarters, but it's not like grossly outside the range. So maybe let's just buy FedEx, bro. What do you think? Okay. The company's new products have poor results. I don't track FedEx. They deliver packages and has a pH ratio much higher than its industry average. So that's a Stalwart. Okay. You know what also has Stalwarts? An index fund. You know what has slow growers? Index funds. Next, we have fast growers. Okay. Fast growers are small, aggressive new companies that grow at 20% per year. This is where the 10 baggers live. Examples include Tesla, which is a massive clown bubble. Google, which it's a better buy than Tesla, in my opinion. And Facebook, which is a much superior company than Tesla. And it's still probably, well, Tesla's the most clownish stock out of all three of these by leaps and bounds. Okay. Fast growers are high risk, Google, high risk, high reward. If you're going to invest in a fast grower, you're likely doing it for the potential of big returns. Just buy the largest stocks in the index, okay? If you want to invest in slow growers, I think that's a typo there. Where and how it continues to grow, okay? Companies should not have excessive amounts of debt. I don't think any of these companies have an excessive amount of debt. Tesla, now see, when it comes to the growth thing, Meta and Google, when ads come back, the recession ends and I think ads will come back, obviously. Ad spend will come back once the trials and tribulations that we're going through now, which really aren't that bad, are over. Tesla, I'm not so sure how it's going to continue to grow like people think it is. These two, they'll probably grow. I could say that, but Tesla, I think at some point they're going to hit a brick wall, but that's just my personal opinion. If there is a particular product you would like the company sells, make sure it's a major part of that business. If there's a particular product you like the company sells, Well, I don't like the Tesla Model 3, and I don't like the Model Y, but it's not a car company, so I guess I'll buy Tesla. The company hasn't been able to duplicate their business model in multiple cities and markets. We want to see that expansion. Okay, I guess that works for Tesla. The PE ratio should be at or near the growth rate. I wonder what Tesla's PEG ratio is. Do they have the PEG ratio? Tesla. Una Tesla. What is Tesla's PEG ratio? Let's see. Peg me, baby. Tesla PEG ratio. 1.28. Okay, well, I guess it's going to grow. It's going to go to the moon. Buy Tesla. You should sell a fast grower if you think it's coming to the end of its expansion phase and rapid growth. There are 40 analysts giving the stock their top recommendations. That is. I've never seen a truer statement than that. 60% of the shares are held by institutions. It has appeared in 3 or more of the top national magazines. Top executives or employers have quit. It has a PEG over 2, and sales have dropped by more than 3% in the last quarter. Okay, so all interesting stuff there. I mean, like, yeah, I could see how all of these would be, indicators that you may want to get out. I don't know about this institutions thing. I don't understand why that would necessarily be a bad thing. This 40 analysts giving the stock their top recommendations. This is actually like the truest thing I've ever seen on this article. Analysts are massive clowns. Never forget the clown market of 2020 and 2021 when stonks went up in straight lines that were massively unprofitable, share diluting, small cap growth trash. And what did the analysts do? What did the clowns that failed out of accounting because accounting's hard and they went into finance? What did the analysts do? They said all the stocks were going to have price targets of this and price target. Oh, it's going to go to the moon and there's so much potential. And they were wrong. You know why? Because they're clowns. When stonks go up, they raise their price targets. When stonks go down, they lower their price targets. They're freaking clowns. Okay? They failed out of accounting because it's too freaking hard. Bunch of losers. So this is probably the biggest one right here. I wonder what most analysts are saying about Tesla. All right, next we got cyclicals. A cyclical is a company whose profits rise and fall with changes in the economy. During the booms, the company will grow its profits and prices will rise. During recessions, profits will shrink and prices will fall. Examples include airlines, car manufacturers, except for Tesla apparently, resources, and energy producers. Cyclicals can be low risk, high reward, or high risk, low reward. Now, these are the kind of stocks like, obviously, you can't do a DCF on a cyclical stock, in my opinion. Because, like, for example, if a stock that goes boom and bust with the economic cycle, if you do a DCF, you're just growing earnings at a certain percentage flat or, certain percentage rate over the next 5 or 10 years. That takes nothing with the economic cycle into account. You're just growing the earnings at a certain percentage, which isn't how these companies necessarily have earnings. Let's go look at American Airlines. I'm curious like how accurate this is. Let's see how much their earnings fluctuate. American Airlines. Planes. All right, the stunk has been down ever since 2020. Okay, let's look at the earnings. Yep, look at that. Damn, I mean, that's kind of an unusual scenario, but you can clearly see like they're going from high profits to losing money to high profits to losing money. Let's see what else. Let me close this. What else do they have? Car manufacturers like Ford. Let's go to Ford. Tesla's like a clown company. I don't even want to look at it today. Let's see. Profit margin of car companies. Yeah. See? Up, down, up, down, up, down, up, down, up, down. So, yeah, with these kind of companies, obviously, you have to kind of, time the cycle. So that makes total sense. But just do a DCF like everything money does. Doesn't make any freaking sense. Okay? Energy producers, ExxonMobil, yes. Energy is very cyclical. They can be low risk, high reward, or high risk, depending on how you can anticipate the cycles. Just guess the cycle, bro. If you are right, you can make 10x your money. If you are wrong, you could lose 90%. God damn. Let's look at ExxonMobil. I actually really wanted to buy oil, like an oil ETF a couple of years ago, just as like a speculation play. And if I had done that, I would have made a lot of money. I mean, ExxonMobil pays a dividend, and on top of that, it just had massive price appreciation. Okay, this is a cycle. But you can't do a DCF and be like, well, the profits historically grew at this rate, so I'm going to grow it to this rate, because there could be a bust. Oil prices could go down massively for whatever reason. Maybe the economy goes to crap, and boom, all of a sudden they're not making as many profits as you thought they were. So, yeah, it makes sense. You should sell a cyclical if it appears to be reaching the end of its upcycle. It's very hard to know. It's easy, bro. It's easy to know when that happens. When something has started to go wrong, very general, inventories are piling up, union contracts about to expire, and capital expenditures increasing. Okay. Next, we have turnarounds. Best Buy. Actually, no, I'm thinking of Bed Bath & Beyond. Never mind. Turnarounds are companies that are down in the dumps. These are the ones that kind of like attract me. You know, it's like, you know, if I'm going to make a bet, it's going to be a company that everybody thinks is trash. It's dead. It's done. But is it really? Is the market overreacting? This is my kind of thing that I get attracted to, which is, you know, very dangerous, but whatever. It's for fun. Turnarounds are companies that are down in the dumps. Their growth may be zero or even negative. They may already be Okay, well, I don't do that clownishness. So have a chance of going to zero. Turnarounds are companies you believe are going to be able to right their troubles and start growing again. If a turnaround can fix its issues, then its stock price can rise very quickly. That's 100% true. Even Tattooed Chef, if they suddenly became profitable, oh my God, that stock would go up a lot. Okay. Never happened, of course. Examples include Chrysler, Geico, and Best Buy. Let's see what happened to Best Buy. Let's see the turnaround story here. We turn around here, guys. Let's look at the stunk price, see what happened to it. I don't know when the turnaround happened. It seems to be doing okay. Let's see. Was there a year where they lost a lot of money? Let's see. Where was the issue? Operating margin, free cash flow margin. Oh, okay. I don't see the turnaround here, but you know, I don't know the entire history of every stock in the stock market. What you should look for in a turnaround are the company has taken actions to improve its standing. The company has a plan. The plan appears to be working. The company is removing failed parts of its business. Do you see how hard this stuff is? It's just a game. This is a gamble. An abundance of cash, low debt, and if they have debt, it is funded debt and not unfunded or bank debt. You should sell a turnaround when it has turned around. The company's become the company it was before. Its debt has risen sharply and inventories are rising twice as fast as the sales growth rate. Okay, that makes sense because if your inventories are rising, obviously you're having a hard time turning out your inventory. But this is the turnaround story, okay? Next, we have asset plays. An asset play is a company that is sitting on something valuable that Wall Street is overlooking. The asset could be something such as a mine, an oil field, cash, or property. Lynch gives the example of Pebble Beach. In 1976, Pebble Beach was selling for $14.50 per share. This gave it a market cap of $25 million. Less than 3 years later, Century Fox bought Pebble Beach for $72 million. 20th Century Fox then went and sold the gravel pit, an asset, for $30 million. The gravel pit alone sold for more than what the entire company was being sold for in 1976, which includes hotels, 2 golf courses, and 2,700 acres of land. Low risk, high reward, but only if you share the value of the. How do you know the value of the assets? I mean, like, you have to have some crazy, like, understanding of, you know, what's going on with some of these companies. Because, like, when you look at a company's balance sheet, you're seeing the book value. You're not seeing the fair value of the assets. So it's interesting, this kind of example of an asset play where the fair value of the asset is not represented on the book value. But my question to you is, how do you know? Like, how do you actually know that? Okay? So, I don't know. I don't like those. This kind of sounds like, what was that stupid stock the bird lady was talking about? It was some stock, like this random company bought another company that had an oil field, just an oil field. They weren't mining it. They weren't doing anything with it. They were just sitting on an oil field. And basically the whole theory was that the oil field, some large company was going to buy the oil field and the stock was going to go up massively. It was that was an asset play, basically. And that didn't go well. You should sell an asset play if its debt has risen, the company's issuing additional shares. The company's selling assets for less than they are worth. Well, obviously, then that means you're going to be losing money. And the institutional ownership has risen to over 60%. So let's read the summary. One thing to remember is that a company won't stay in the same category forever. A fast grower may become a stalwart and then a slow grower. That's what you got to be careful of. A lot of these people, they buy these fast growers, right? They buy Tesla or Google and Facebook, which is now Meta. And, the stock goes up a lot. And like, oh my God, it's growing so fast. And then all of a sudden it stops growing as fast. And then guess what happens to the valuation? Plunges. Was it Netflix? I think Netflix is a great example. Let's see. Here's Netflix, right? So let's look at the growth rates. Let's look at the annual growth rates. So this was a fast grower. That is a fast growing stock, okay? And then the growth rate really started to slow down. And what happened to the stock? Oh, it plunged. Look at that. Look at that destruction. Remember that, Joseph Carlson? How'd that make you feel, bucko? It absolutely plunged. Now it's recovered, right? But that's the risk you take with these fast growers. They're not sure bets because the market knows how fast the stock's growing. And they all have an estimate of where it's going to go. And if something doesn't meet expectations, if growth doesn't meet expectations, these stocks plunge and they plunge hard. Netflix's 5-year return, if you had bought exactly 5 years ago, is 6.24%. So it's all about when you buy these stunks, ladies and gentlemen. Now, which one do I like the best? I mean, turnarounds are interesting to me. Cyclicals, nah. Stalwarts, Or you can buy an index and buy them all. So you can check the key characteristics the company should be exhibiting, such as room for expansion. It should also allow you to set reasonable expectations. You shouldn't expect growth of 20% in a slow grower like Coca-Cola. Lastly, it can help you identify reasons to sell. So I guess after reading this article, I am now a master stock picker. Okay. I'm going to go do a bunch of asset plays because I just know the real value of the underlying assets in the company's balance sheet. I just know it. I maybe read an article about it or maybe looked on Zillow and now I know. So that's it. That's the 6 types of stunks for Peter Lynch. Mr. If you buy the index, you'll never beat it. Shock. What a shock. MMTLP. That was it. MMTLP was an asset play. 100%. Oh, you look at the balance sheet, and it doesn't look that great. It doesn't have any revenue, basically. But the oil, it's under the ground, or there's oil there, and it's liquid, and it's black and liquidy. And when an oil company comes, they're going to buy it, and then it's going to go up massively. The stock's going to go up massively. Yeah. All right, let's do some comments. Strong man, my dong man. I like it. Peter Lynch inspired me to buy Costco. What's wrong with following the market? Now, following the market, I don't think you should do that. The more you watch the news, like think about Jeremy. Like he watches, I remember a video, he said he has CNBC on in the background all the time. It just fills your head with nonsense. And you have different people with different opinions. And basically when you watch that crap, you have no idea what's going on. You don't learn anything from watching the financial media. And if you're following markets all the time, what are you going to be tempted to do? You're going to be tempted to time the market. I don't really follow the markets. I mean, obviously I'm a finance YouTuber, so I know where stocks are. I know what sometimes stocks go up and I hear about it, but I don't like religiously follow the markets because it's a waste of my time. Peter Lynch is almost as strong. False. Let's see. Sup, y'all. First like. Thank you, sir. Dividends. Crush the S&P before the S&P crushes you. You can lose 100%. That is true. You can lose 100% of any stock. You know what won't go down 100%? An index fund, a total market index fund, unless the world ends. These guys just look back at the last 6 months chart and buy whatever went up the most. That is exactly what retail does. Or they look back further. It doesn't matter. Like all they do is just, I'm telling you, the taint of past performance, it really is prevalent on YouTube. Let's see. 10x my index. Jeremy Lefebvre investing style is superior to Peter Lynch's. Lefebvre will be a billionaire. Peter Lynch is not. Can you imagine the arrogance of Jeremy Lefebvre? Not even Peter Lynch. One of the best stock pickers of all time, according to that article. And Jeremy thinks he's going to be richer than him. Oh my God. What a clown world. Has Lefebvre just sold Corsair my horsehair? No, he 10x, bro. He never loses money. The one after slow grower is shrinkage. Oh, that's probably a turnaround stock. Woo! Strong man. Why have cars become so expensive all of a sudden? You think it has anything to do with maybe car manufacturers, major capex, or EV manufacturing neglecting their core? Why are cars so expensive? Well, it's either a demand thing, right? Either a lot of people are trying to buy cars and there's not enough supply. That's one way. Or another way is the input costs have gone up. What are the input costs of cars? Labor, manufacturing, overhead, and raw materials. So it's probably a combination of, I would say it's probably more of a cost thing. Just not even researching the market. My guess would be costs have gone up. If labor goes up, if raw material costs go up, if with inflation, if factory overhead goes up, which is all allocated to the price of the car, to the cost of the car, that would result in cars becoming super expensive. Because if you think about it, interest rates have gone up. Wouldn't that slow down demand? So what's causing the price of these cars to keep going up? I don't know. I hate cars with a passion. They're true wealth destroyers. Can we hear you plug your book? Buy my book. Oh, let me plug my book. Hold on a second. Pull up my book. Stop being a broke loser. Stop being a broke loser. My greatest accomplishment. Okay. Let's look at my book, boys. Did you guys know I had a book? But a lot of you didn't. So here's my book, Stop Being a Broke Loser, by Christopher Bell. You know who that is? That's me, mother effer. That's right. I wrote a book. You jealous? You could buy it with one click. Just click it, bro. Okay. So I wrote a book called Stop Being a Broke Loser a couple of years ago. Basically, here's some of the stuff I talk about. Change your mindset, cash management, risk mitigation, investing. Oh, and this chapter right here, chapter 5, do not invest like a dude, bro. That aged like fine wine. But yeah, buy my book. It's on Amazon. It's called Stop Being a Broke Loser. Give me your money. Thank you. Financial advisor, me harder, BB. Cyclicals, my tickled nipples. Chicky nuggies. Buy shiny rocks, bro. Yeah, that's how you build wealth long run. You just buy shiny rocks, Not companies that produce real goods and value. Just buy a shiny rock. It's easy. Turnaround was Netflix. I don't know. I wouldn't call it a turnaround. I think it just became a slow grower. But it wasn't like a dying business. It just became a slow grower. That's what happened. You should really only buy cyclicals if you work in the industry or it's super obvious it's underpriced, like oil after the COVID crash. I agree. I mean, people think they know more than they do. Like, people don't understand in the market, like, everybody's watching, okay? You may get lucky once or twice, like you buy stock and then the market suddenly corrects the stock, but it's a lot harder than you think. Like, a lot of people, they think, like, they read an article or they read up a little bit on an industry and they think they're experts in it. It's like, you realize there's like institutions out there, they have like full-time analysts that research this crap, okay? And you're just some clown buying individual stocks because you think you're a freaking genius because you bought stocks in 2020 when you first started investing on Robinhood. Yeah, you're a genius. MMTLP, the bird lady was smarter than the whole ape movement. I don't know about that. I think Marius Skaniski has an asset play called Oracle Resources, as well as potential fast grower in Voxter. I should review his stocks. He might get mad at me. Buying growth stocks is basically playing chicken hold until the growth slows and they plummet. People just price in growth perpetually. Pretty much. It's like, oh, just buy fast growers. I mean, obviously you just want to buy a fast grower. Why would you want to buy a slow grower? Fast growers grow fast, right? And your return is going to be at the rate of growth. It's common sense, right? Yeah. It's easy, bro. HP went nowhere in 5 years. Uh-oh. You're better than Lefebvre now that you read the article. That's true. I don't think he knows how to read. Oh, here's Sasha. Picking stocks is so easy. If your stock goes up, you're an investing genius. If it goes down, you get to buy the dip. Win-win. That is YouTube finance in a nutshell. AT&T. Oh, I actually want to review that stock. I was looking at that earlier today. I was like, good God, this is a stinking pile of trash. Kevin is crushed. Yeah, PP went up in the last 6 months. Obviously, he's a genius, Remember, Kevin made a lot of money during the clown market, too. What happened to that? Only Jeremy can lose 100%. It's his expertise. That's true. That is a rare skill. VT, my ET, EVT. Let's see. The book is a good read as long as you ignore some typos. Yeah, I mean, I'm not going to sit here and say, I had it professionally edited. I mean, no, I wrote the book on a Microsoft Word. I checked it a couple times, and then I published it. There was no editing. There was no professional editing that went into my book. But you know what? All my money is pure profits, baby. I made like $800 off the book or something. Not bad. It's good side money. Do you have hearing loss? Do you? 100K was bank in 1975. Today it's okay. Your 11-year VT has been getting you 6% versus the 15%. You have done a lot of damage to your portfolio. Bitcoin's return was 1,000 million %. Tesla's return was 1,000. You've done damage to your portfolio. Dogecoin's return was this. You've done a lot of damage to your portfolio. This and that and this and that. Okay, let's see. Was VT's return actually? The VT ETF. Let's see. Let's look at these horrible returns over 10 years. Na 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 10 years, just under 9%. Oh, 6%, bro! Oh my God, it's so bad. These aren't bad returns. Okay, so if you go right during this financial crisis, okay, when the ETF first started trading, yeah, it had 6.82%. That's not my return. I've been dollar cost averaging into this thing, okay? You people, man, I don't know, man. Like, you retail people, I think you're doomed. I really think a lot of you are just doomed to be poor. I'm sorry. What went up a lot? I am. Tattooed Chef must be a fast grower. Yeah. Oh, look what happened to that one. It was a fast grower. Look what happened to it. Let's see. It's not. I could find something that had more returns, so it's not great returns. Yeah. And you got to think about this. You guys really think that the average investor gets the returns of the S&P 500? They don't. They don't. I have outperformed all of you. All of you. And I will outperform all of you because I buy and hold for decades. You know how many times I've sold VT? 0. Okay? You're going to be buying and selling and paying taxes and going into this because it went up a lot and then going into that because it went up a lot. And then trust me. Okay? Just because the S&P 500 went up X percentage does not mean that people got that return. No. Guaranteed. Most of you clowns were buying and selling and, the market's overvalued here, so I'm going to sell here, and then I'm going to buy back here, and you missed out on gains. I 100% guarantee, okay? So get your laughs in, because something else went up more than VT. I mean, something went up more than the S&P 500. Does that make the S&P 500 trash? No, it doesn't. Diversification index equals VT. Yes, because all the retail investors are so much better than the index. They're just so much better. Do you think the sin of greed plagues it? I think it's everywhere. Great returns come with great risk. Yeah, losing your freaking money is also a great risk too. Why are you an S&P hater? It's the ultimate. Oh my God. I don't understand this. I give up. I surrender. The clowns have won. I hate the S&P. I don't have any U.S. stocks in my portfolio. 90% BABA. My total returns are 6%, even though I actually showed them. They're not. They're higher than that. I'm just a clown, okay? Everybody's better. Everybody has Tesla. Everybody's 10Xing except for me. I'm just an idiot, okay? Jeremy's the real investor, okay? All right, guys, that's it. Talk to you later. Cheers.